financial statement analysis is basically analyze those three major financial statements. So how are you going to analyze? Okay, why you have to analyze the financial statement? The main reason is that, okay, so two companies, they report the same like a profit, 1 million. So company A report 1 million profit, and company B also report 1 million. So how can you tell the difference? How can you tell the difference? The question is that different company, their size is different. You know, that company might be 200 million, you know, market, including the asset or market cap. What about another company? I don't get maybe 10 billion, right? 10 billion. So that company is a 10 billion company, and they only generate 1 million income, right? So that's the problem. So when you compare the two things, you wanted to compare is that the common size. Common size is you don't want it to have the size effect when you do the analysis. Okay. Obviously, you know, if a company they have their total asset or market cap is only 2 million, they generate $1 million US income. That's a great business, right? Great business. But if your company is like a 20 billion as a huge company, they generate only 1 million income. Okay, that's might not be good. Somewhere might have some problem, right? So that's the main reason you do financial statement analysis. So financial statement analysis, we focus on the major financial ratios, okay? The major financial ratios. Okay, the ratio, 5 different categories of those ratios. We are going to look. The one is the profitability ratio. Okay, profitability ratio. How the company generate their profit. And second category is called liquidity. Okay, liquidity. The liquidity is measure the short-term debt and the short-term liability, right? The liquidity ratio. And the third category we called is a debt ratio. Debt ratio is the coverage. For example, your interest coverage, your fixed asset coverage, the debt ratio. The first is called asset activity ratio. Okay, asset activity ratio, sometimes we call them efficiency. Okay, efficiency ratio. Efficiency is the company, how efficiently they use their asset to generate a revenue. Okay. Last is the market value ratio. Okay, market value ratio. How those ratios are associated with the market price or the market performance. So that's the ratio analysis we are going to talk about. And so to study this chapter, I better, you know, just take out a piece of paper, you know, you write down all those formulas. Okay, so put all those formulas together. And so I believe I have that one posted on the course content area. If you didn't find that, you know, let me know. So I prepared that formula. So if you know, sometimes I prepare the formula and you prepare the formula. It's a little bit different is that when you prepare the formula, so you understand When I give it to you, you say, ready, that's the formula. Okay, you might not understand why, right? So better, you just write and organize that and put your own formula for those problems and calculation. Okay. The profitability. Profitability is generate basically the company's profit, right? And the first one we called is gross profit margin. Gross profit margin is your gross profit divided by your total sales. Okay, total sales. Also, this one is sometimes you remember, so the sales on the first line is called a net. Okay, net sales is already exclude those selling costs, and also that is recorded as a revenue. Okay, sometimes you see the financial income statement is called a revenue. The sales is also called a revenue. So use that gross profit divided by total revenue. That's called a gross profit margin. You can see how to get the gross profit margin. Gross profit margin is you can see the first line on the income statement. That's the first line is called revenue, or sometimes it called sales. And the third line is gross profit. Right? Use the gross profit. Those data you only need income statement. Okay. Although you have a balance sheet right there, you don't need a balance sheet. You only get the data from income statement. You can calculate the profit margin, gross profit margin. Gross profit margin, the higher the better. Okay. So once you got the ratio and choosing, okay, you can do is use that profit margin to compare the profit margin of the same industry. Okay, get to the industry average and to see where is the profit margin of your company. Your company is higher than your industry, that means you did better, right? You outperform. Okay, so the profit margin is the higher the better. Okay, the higher the better. It's better to be higher than the profit margin of that same industry. Also, you can do is to compare the profit margin of this year and the profit margin of last year, the year before. So you see your profit margin is increasing. Okay, if your profit margin is increasing, that's good. Okay, that's a good thing. You may in that the profitability of your company is strengthening, right? Improving. Next that we talk about is operating profit margin. Okay, operating profit margin. Operating profit margin is your operating income divided by your total sales or total revenue. Your total revenue for a business, why operating income, operating profit is important? Because that's your main business. Okay, you are doing hamburger, you're selling hamburger, that's your main business. It's not you just got a hamburger shop and you sell that hamburger shop, you got a lot of money, and then you record it as your revenue. Right? That's not your main business. You could get a lot of money, you just open a hamburger shop and then you see a lot of customers come in, you're starting to sell it. And then you got another hamburger shop, right? You sell the hamburger shop, you can make a lot of money instead of just focus on doing hamburger, improve the quality of the hamburger. You're just doing the hamburger shop, you buy and sell hamburger shop, you still can make money. That is not your operating income. Operating income is the income you generate from your main business. Okay, so you are doing a computer assembly or sell computer, that is your main business. Your income from buying or selling a computer, that's your main operating income. You could get some other money, you buy another small shop and you sell another computer shop. That is not your main income. Or you sell your asset. Okay, so that's operating income. Operating income is, you can see where you can get operating income. This is your operating income from income statement. The revenue or total sales is also from your income statement. So both the numerator and the denominator are coming from your income statement. Okay, income statement. And operating income also has a name. Do you remember what is other name for operating income? Yes, EBIT. Yeah, EBIT. 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 So earnings before interest and tax. Okay, earnings before interest and taxes. That is also called operating income. Okay, operating income, another name is called EBIT. Okay, so you can see a lot of accounting books or some other financial book, they using EBIT here instead of operating income. Another important one is called net profit margin. Okay, net profit margin. Net profit margin is a net income divided by your total revenue or total sales. Use a net income. Okay, so the net income, you can see is your, the net income is the one after the tax, okay, after tax, and that is your first line of revenue, okay. So we call net income in income statement is the bottom line. Okay, sometimes the, finance or accounting books, they use the bottom line is a net income. Okay, the net income is the bottom line, and the sales is the first line. Okay, the first line, all the revenue, the first line. Okay. And so there are some other things, when you look at the 10Q forms, is after net income, they have some other income, okay? Is a net of tax. Is that what I'm talking about? They sell their business or sell those property or machines, so they make money. Okay, that does not count as your operating income, but they do generate income, okay? The income you need to look at, when you see the income statement here, after the net income, there are still some other income here. Those income is not a sustainable, okay? Not sustainable. They might, sell a property or equipment. They generate a lot of money for that year, but they cannot sell their property always, right? They're not sustainable somewhere under the net income. So net income is the bottom line. Okay, so we have, you can see all those, we talked about profit, and some later on when you you already studied finance, so someone asks you, you have a business, ask you, what is your business profit? Okay. You need to specifically, specifically and to tell them, no, my company has a gross profit, operating profit, and a net profit, right? It's not just the profit. When you just talk about, okay, how much is your profit, it's not clear. It's not. It's confusing you. Or people, even you tell them, okay, my company got a profit, 1 million. What do you mean 1 million? Is it gross profit or is it net profit, right? So you need to ask them, what exactly you're talking about the profit. Okay? The profit is different. And okay, also you have you have a return on assets. And the profit margin, you can see the profit margin, they have another name, sometimes as called return on sales. Okay, return on sales. And this one is a return on asset. Okay, return on asset. Profit margin is also called a return on sales. But return on asset is your net income divided by your total asset. Okay, divided by your total asset. Now you can see here, you need to get the net income, the bottom line for income statement, and also you have to get data for the balance sheet, your total asset. Okay, so this time you have to use the data from both income statement and balance sheet. Okay, it's not only one statement you can get the result. Now you have to use the data from both, right? From both. Okay, and so the return on asset is, how much money you generate based on the total asset, based on the total asset. And return on equity. Return on equity. Okay, so return on equity is really, really important because this is a net income divided by your common equity. So the company, typically, they have money invested by the owners or stockholders. Okay, we only count those investments as the net asset. Okay, net asset. If you talk about the total asset, you have to exclude the debt. Okay, you borrowed from the bank. It's just namely that is your asset on your account. But you have to pay. You have to pay back to the bank because the money that's you borrowed from the bank. Okay, so only the equity part you don't have to pay back. That's the company's net asset. So, so net income divided by the common equity. Later on, we're gonna talk about the DuPont analysis. Okay, we figured out what the source of the company to generate profit. So the modified DuPont equation on the left-hand side is a return on equity. So return on equity is going to be your net income divided by the total owner's equity, okay, shareholders' equity. Okay, so this is the two part on the right? So one is total liability, and another one is total owners equity, right? Total owner shareholders equity. So this part is, sometimes student confusing about the how to calculate return on equity, because here, you see common stock, right? Okay, it's not just using net income divided by common stock. Has to divide it by the total owner's equity. Okay, if you just use the common stock, okay, you got a wrong answer. Okay, that's a typical mistake here. It's not common stock. Yes.
Why would you call it common equity instead of total equity?
Yeah, so it's better just change that word to total owner's equity, right? Or shareholders' equity here. Yeah, I will tell you later, there are some mistake here is coming from the publisher, That's why they confuse people. Yeah. So here you need to understand it's not just a common stock. It's a shareholders' equity or the total owner's equity. Here is correct, okay? Number is correct, but here you need to understand this part is the total owner's equity. It's not just common stock. You look at the number is still there, right? The correct is 1,700. But here they're using common equity. It confuses a lot of students and then lead to the wrong solution. Okay, that's a you might create your own formula. Use the total shareholders equity. Okay, so now you understand. Okay, you should use the owner's equity instead of the common stock. Okay, any questions? Okay, so we have another one. I just wanted to tell you is called basic earning power. Basic earning power is BEP. Okay, BEP is a basic earning power. That one is also very common, and it's not listed on the slide. But I wanted to show you what is basic earning power. Okay. Okay, the basic earning power is your EBIT divided by your total asset. Okay. Is EBIT is operating profit, right? Divided by your total asset. That is called basic earning power. We use a net income divided by total asset, right? Is a return on asset. But if we use operating profit divided by the total asset, that is called a basic earning power. It's also a profitability ratio. Okay, profitability ratio, and it's a pretty common use. Okay. Next, we're gonna talk about is liquidity. Liquidity ratio. So liquidity measures the ability of the firm to meet its short-term financial obligation. The company's ability to pay off its short-term debt. Okay, the short-term debt. Short-term debt, let's talk about, for example, you have to pay your rent, you have to pay your utility, right? That's the short-term debt. The same thing, like a business, you have to pay your employee their salary. If you didn't pay them, in the short term, and they will looking for another job, they cannot survive. So the current ratio is your short-term obligation. Basically, we focus on the current asset and your current liability. Okay, remember we talked about current asset is the asset is gonna expire in 1 year, right? Anything we talk about current is a short, okay, the short term. They are going to expire in 1 year. Okay, they won't last more than 1 year. So that's a current. Sometimes we call them a working capital. Okay, that's a working capital. Working capital is the capital you're gonna use for daily operation. Okay, daily operation is a working capital. Working capital including a current asset, current liability. So all you can do, right? Some students they do internship. They study accounting and they just do the most of the frequent work is the account receivable, account payable, ARAP, right? ARAP, that's a lot of students you do internship, okay, for accounting. And you got a quick book and a training for the several days or a week, and you can work on that, do the ARAP. That is working capital. So that, every day you receive order, you put on AR. Every day you order something, you pay AP, that's the work you did it every day, okay? Every daily work. That's why, easier to find internship, because those every business, they need people to do every daily work. It's not like an investment. Investment, you have to invest, you decide, you put money in there for 2 or 3 years or long term. It won't change. So that money is already invested and lost several years. Okay, this is a working capital. Working capital is for everyday operation. Okay, the first one we called is the current ratio, current asset, and current liability. The benchmark, we have a number is greater than 2. Okay, you remember that? Okay, the current ratio, more likely, if you wanted to get a loan or something from the bank, at least greater than 2. Okay, greater than 2. So your total asset, your current, asset you can use or easy to convert into cash must be 2 times higher than your debt or liability you have to pay recently, right? Most recent debt has to be, your asset has to be more than the debt, at least 2 times. Okay, you have to pay your rent, you have to pay your utility, food. When I see your account, bank account, you have to have at least 2 times that money in your account so that I can make sure, you have ability to pay off your short-term debt. Okay, so that's the current ratio. And then also for a business, the current ratio you can see is your current asset, total current asset divided by total current liability. And we have an even more stringent one, is called a quick ratio. It's called a quick ratio. The quick ratio is your current asset has to exclude your inventory. You cannot count the value of your inventory as your short-term asset. Why? Because it depends on the market, can you sell your inventory immediately to get cash? Okay, some of the company might be, some of the company might not. For example, like the oil industry, right? Oil industry, you have inventory, you have a huge machine in your inventory, but doesn't mean you can convert that machine into cash quickly, especially when the oil market is not good, right? Not much people need that equipment. So you could hardly to sell and change into cash. But you have to pay your rent next month. You have to pay your employee this end of this month, right? How can you change your sell the inventory become cash? They don't want the inventory. They don't want it to, the employees, they don't want it to carry that huge machine back home. They want money. They want the paycheck. So you need to exclude the inventory. So the quick ratio has to be greater than 1. Okay, greater quick ratio. Usually we need that ratio has to be greater than 1 at least. Okay, also called acid test ratio. Okay, acid test ratio. Okay, debt ratio. Okay, some of the time, students confusing the word is called solvency ratio. Okay, so the solvency ratio is assess a company's ability to meet its long-term financial obligation. Okay, this is for long-term financial obligation. Liquidity ratio is for short-term financial obligation. Okay, so that's a difference. And so do not, confuse with the liquidity ratio and solvency ratio. Okay? Solvency ratio is for long-term obligation, and the liquidity ratio is for short-term. Okay, so you can see the ratio. We're gonna talk about solvency ratio. Is a debt to equity ratio, interest coverage ratio, debt to capital ratio. That's what we talk about here. Is sometimes we're using the debt ratio. Long term, okay, this is for long term obligation. The debt ratio, is what we talk about solvency ratio. Solvency ratio. Does the company has that ability to pay off their long-term debt obligation? And that will be you the total debt to your total asset. All right, total debt divided by your total asset is your debt ratio. Okay, your debt, what is the debt? Remember the debt is your total liability. Okay. Okay, come here, you can see is that so the debt is your total debt is your current liability plus your long-term debt. Okay. Current liability is short-term debt and the long-term debt divided by your total assets. That is your debt ratio. Okay, specifically, I don't want to confuse you, is that the CFA has clearly to specify the difference between debt and liability. Okay, the debt, like CFA, they talk about debt is that does not include the accounts payable and accruals. The accounts payable and accrual, this thing is non-interest bearing asset liability. So, but here we do not have a clear cut about what you're supposed to consider the debt. Okay, and the debt is only, okay, strictly the debt is only those debt have to pay interest. That count towards the debt. Otherwise, they don't consider it as debt. And but for the textbook we use in this one, okay, just use the total debt, and you just consider debt is a liability. It's the same thing. Okay, we don't want to confuse you. Okay, so the total liability divided by your total asset is your debt ratio. Another one is debt to equity ratio. Debt to equity ratio is a total liability. Okay, the same thing. The common equity here is the total owner's equity. As the total owner's equity. Your total liability divided by your total owner's equity. Okay, that is your debt to equity ratio. For example, you know, it's a total debt to your total asset ratio. Let's say 50%. Okay, so your total asset 50% is debt. What about the other 50%? Is what? Equity. Okay, your total asset could be only two parts, either debt, either equity. Okay, if 50% is debt, another 50% has to be equity. If the debt to total asset ratio is 50%, the debt to equity ratio is 1. Right? You got it? What I'm talking about? Yeah, 50% debt, 50% are gonna be equity. 40% of that, 60% goes to equity. Okay, when you add it up, it has to be 100%. Okay, so you can see the total owner's equity divided by your total asset, that is the equity, right, part. If you use the total equity debt divided by your total owner's equity, that's the debt to equity ratio. Okay, the debt ratio, we talk about this one is called times interest earned ratio. Times interest earned ratio. This is a times interest earned ratio is a time ratio. You see the this is the numerator is operating income, is EBIT, right? EBIT divided by interest. Okay, divided by interest. This number, when you go to the bank, usually the require has to be greater than 4. Okay, times interest earned ratio usually has to be greater than 4. Okay, greater than 4. Okay, so you can see the operating income divided by your interest expenses. Okay, that is times interest earned. Sometimes they call the interest coverage ratio. Okay, the same thing. And they also call interest coverage ratio. And it's the ratio greater than 4. It has to be greater than 4 in order to get the loan from the bank. So the bank checks, you know, do you have enough income to pay your interest? That's what they're looking at. If your income couldn't even pay off your interest, how come I lend money to you, right? Yeah. Okay, that's all for today.